So you're doing an M&A transaction and you're wondering, what are the top 5 mistakes that you can make along the way that your external auditors can get you related to SOX? Hi everyone, this is Kim Lay with A2Q2, your SOX strategist, evangelist, catalyst, advisor. And in this video, I'm going to share with you the tips from information used in the control and how this can be a potential problem for you if you don't get ahead of it early on. So in an M&A process, there are typically 16 types of documents or types of information that you can be used throughout the process. And along the way, if you were to save evidence of this, save each of these pieces, this will help you later on, 6 months from now, 10 months from now, when your external auditors are asking you these questions, you can easily pull it out rather than reconstruct the evidence or reconstruct the story around it. We also know that some of these transactions for M&A, they're quick phone calls, they're conference calls, they're meetings, live types of interactions, and if you don't capture the essence of these conversations at that time, it's very hard to go back and reconstruct it. So I'm going to run through the types of documents that you should be saving as related to this, and that will help you. So the first one are going to be board minutes. That's typically very easy to get because your general counsel is very good. They'll have these types of minutes. Equally important in the minutes, besides the board approved this transaction, are the board decks or the summary of terms that were presented to the board. And that's because throughout a negotiation, there may be multiple iterations of the terms and conditions that are presented, and your purchase price can change up and down. And so that final approval from the board also needs to be accompanied by some type of, these are the terms and conditions the board is approving to, or these are the board decks that we presented to the board that they used to make their decision. So number 1, 2, and 3 are very much linked together. Number 4 is the merger agreement. So once the board has approved a merger agreement or has approved the transaction, you're going to go and someone's going to draft up this long document, and it's going to be signed by both the target and the acquirer. It's typically at the very top, the CEO, the CFO, or the general counsel is signing some of these critical documents. And so you want to save that with evidence of date and signature, who signed off on it. Related to this is then going to be the opening balance sheet. What are you actually buying from the target? And again, I've seen instances where the opening balance sheet can change. If you move the date of a transaction closing from the 1st of the month to the 5th of the month, or the middle or the end of the month, that document can change. So save whatever is the last version and make sure that that's the final version that agrees to your agreement. The other one is an internal forecast, a 3-year, a 5-year, some type of model. Before you even started out to look for a target to buy, internally as a company, you probably did some type of analysis that said, if we were to buy a company of this shape, this size, for this particular sector, it would help our business grow by 20%, 50%, 100%. What were some of those internal assumptions that you built in before going into this? And then when you come out of the negotiation, it's going to be your business assumption plus what the asset, the target company's strengths are, to come out with a deal model. The deal model is going to be, we're going to pay you a certain percentage of retainment, or we're assuming that revenue is going to increase a certain percent, or revenue is going to decrease, or we're going to divest of certain aspects. What was built into that deal model? And the reason it's so important is later on you're going to use that deal model to give to your valuation firm, and that's what they're using to put a price on what you're buying. Finally, as you have these agendas, as you have these calls, real-time meetings and calls and so forth, if you have agendas, to save those agendas, because that will help, especially for live meetings where lots of things are being discussed. No one's really taking detailed notes. At least if you have bullet points of what the agenda items were, that will help you. And then along the way, there are going to be lots of emails, Slack messages, some type of correspondence back and forth. Saving those correspondences of, let's negotiate for $1 million, but now because we found a liability, let's decrease it to $600,000, but then there's another asset, let's increase it back up. That back and forth, having that paper trail is so helpful to you. And then when you get to the due diligence, you may be hiring a third party to do a due diligence presentation, some type of diligence, if there's that's being used. And then when you gather all these inputs and give it to your valuation firm, they come back and say, you've just bought $1 million worth of assets. Here are all the different types of assets. There's physical assets, there's intellectual property, their customer lists. They'll detail those out. And so that's why it's important on your valuation report. And typically there's some type of tax review. Are there tax write-offs, tax advantages, tax liabilities, or positions that you're taking as part of buying this company? If you're consulting with a tax expert or a third-party expert or your internal in-house experts, having those types of documentation are written up on what your assumptions are. All of that is needed to come out with your purchase price allocation. So you've bought something for $1 million. How do we allocate it to the different assets and the different liabilities? And then writing an accounting memo. Typically a third-party consultant helps with that, who's very technical, or your internal in-house technical accounting director, manager is also writing that, making sure that you have that memo reviewed and available. And then from that memo is going to be a series of journal entries that you're recording on your books to get this acquisition, this new asset on your books. And finally, if there are bank statements or wires, typically wiring money out, wiring to escrow, wiring for deposits, those types of things, those are the types of documents you want to be saving along the way. That's it for this segment. Look for my next video on the next top 5 mistakes to avoid. Talk with you soon. Bye-bye.